Okie dokie, R2F here with a topic that I would like to talk about today, which is different ways to manage your trades. Um, there's no right or wrong way to manage a trade, okay? But what do I mean by managing a trade? Let's say you get into a long, you know, price is moving in your direction. There are different options you can take, right? You could utilize things such as trailing your stop loss or taking partials, or perhaps you don't want to use any of those things and you just have a static position and that's your strategy. Okay, so there's no right or wrong way to do it. It just depends what you've tested and what suits your personality and style of trading. What vibes with you. Okay, so I'll use the position tool here provided by TradingView to give an example. Let's say you get into a position here on Australian US dollar over here, right? Let me just adjust this. And the general way people use stop losses, and I hope you are using a stop loss when you're trading to protect your account, right? The whole point of a stop loss is to protect you from losing your entire account and it's game over. Okay, so you have your entry, you have your stop loss, you have your target, and here you have your risk to reward. Okay, so let's say you get in at a 1.5 risk to reward, whatever the strategy you're using, okay, and you have your stop loss at a swing low over here, and you decided to get in here, right? Because you felt price was going to move higher. In this case, price moved all the way to your target pretty quick. But while price was moving, let's go to a lower time frame. Let's go down to maybe the 5-minute and have a look where that even was over here. Okay. So on the 5-minute, there's all sorts of candles that are happening, right? You're seeing price expand, you're seeing it come back down. And in hindsight, it's quite difficult to imagine. Even using the replay tool that TradingView provides over here, it's also quite difficult to imagine unless you're watching it live, because each one of these wicks were once a full-blown engulfing candle, right? Like this red candle here, this was once an entirely red candle all the way until here. And one may be thinking, it looks like it's going down. I gotta get into that, and it just keeps chopping around and it keeps messing people up, right? And then it starts to move up, and you thought your short was wrong, and then it moves down. So basically, it's it can trip you up. Okay, so let's say you get in over here at a retracement. Maybe you put a fib from this level to this level, and you were like, on the Fibonacci, I'm going to get in, and you put your stop at the swing low just to be safe, targeting a 1 to 1.5. Yeah, so you're risking 1 to make 1.5 as a multiplier. So you get in here, price is moving, moving, and yeah, little to no drawdown. Okay, so if your style is having a static trade, you just leave it. It's basically set and forget type of strategy. You get in, you leave your computer, or you watch it, whatever, but you're not touching anything. If it goes to your target, great. If you get stopped out, great. Okay, so another thing people can use is trailing their stop loss. And there's different ways or rules or criteria people use in order to trail their stop loss. Let's say they make about 1R. When price moves 1R, they trail their stop loss to either half or all the way to break even so they don't lose any capital. Okay, another way is taking partials. So when price goes to, let's say 1R again, they take half their position off and then either maybe trail the stop loss or don't. Okay. And some people they keep trailing their stop loss higher and higher. right? So trying to give an example here. Let's say this is your stop loss line. Okay. And as price is moving up, let's just use the replay tool. Okay, it's moving up, it's moving up, it's moving up. Okay, now they're trailing the stop loss. Maybe they trail it here. It started to move up. Maybe they trail it all the way to this candle. It's moving up. They're just continually trailing it to book the profits before taking any drawdown, right? So they just keep trailing it, trailing it. Maybe they hit their target. Often people use this method is when their main target is hit, but price is dropping hard and they're just trying to get more out of their position. So just keep trailing. For example, trailing it here. Price keeps moving and here they get stopped out. That's just one way to do it, right? One may be just to trail it back to about 1 hour of the position. That's if you're using, risk to reward to measure. I myself, I use ICT's concepts, so I'm doing it at different PD arrays, so different areas based on analysis. Okay, in this case, hit the target, and one may take all the position off or most of the position. I myself, I like to leave a little runner, so I tend to leave 10 to 20% on just in case I'm part of a higher time frame move. But usually no more than that. I try to, unless I have a higher time frame bias and the possibility of catching a short or long that really runs, then I may leave up to 30%. But most of the time, I'll be taking the full position off and occasionally 10 to 20, unless I have a higher time frame bias, right? So, the main important thing about this is having that data to look at. It's no point trying it once or twice, saying, well, that's pretty good, that works pretty nice. In the next trade, you get stopped out and it really runs, and then you get upset. Or you've taken so little profit and then you get stopped out at break even and then it runs. So what's important is having that data from testing. Okay, first step is testing in a back tested environment, such as using the replay tool. Or you don't even need the replay tool. Just look at the chart and be honest about it. As long as you have clear rules on when to enter and you're not being biased, then do that. Then you can use the replay tool. You can forward test using just demo trading or paper trading, and then test it in a live environment with a little bit of funds, just a tiny bit, just to test it out. And then you have that data, and then you can tell, is this a viable way for me to trade? Am I making more or making less money, right? Because you got to treat it like a business and you got to fine tune it. You're going to take losses, there's no avoiding it, but as you get more experience, of course, losses will be less. But what's important is, do you have a positive edge? Are you making money in the long run? Okay, because some environments may be difficult to trade, such as this consolidation, right? I think most traders are generally ones that trade with a general RR, and they're usually targeting highs and lows on a larger scale. So in this instance, price, chops around a lot, moves down, goes up, and it just kind of consolidates, chopping up traders that are highly leveraged and trading on this sort of time frame. But this is just a general consolidation. But yeah, so whatever method you use, make sure you have it tested, and there's no other way around it, and besides getting that experience and trying it for yourself. Okay. So I hope you found that a bit useful. I don't know how many of you, actually manage your trades. But please don't manage your trades based on your gut instinct or just what you're seeing on the chart. I know gut instinct, can be quite valuable because humans are quite the computers. If you have, tons of experience, then of course it can be quite valuable. But if you're relatively new, just looking at candles and trusting your so-called instincts is not a good idea, because these markets are designed to take your money. They're not easy. Okay, that's the whole point of it. You got to be a master of your emotions and your discipline. So yeah, I hope you found that insightful. And until next time, safe trading.